Good morning everyone and welcome back to Morning Markets here at True Potential. Today we're going to be covering the surprising strength in UK jobs data, and we're also going to cover Chinese GDP and what it means for markets. So we saw real strength in UK jobs data, which was released this morning for the month of February. We saw a big out of consensus print of over 150,000 new jobs added, well above consensus. But what's unusual about this number is where those jobs were created. At this point in the economic cycle, it would be normal to expect the majority of those jobs to be added in full-time employment. In fact, we're not seeing much growth in UK full-time employment at all early in the year or even through the last half of last year. What we're actually seeing is the real flexibility and dynamic nature of the UK jobs market take hold. We're seeing huge job creation away from full-time employed, in particular in part-time employment. So the strength in part-time employment has seen over 100,000 new jobs added there early in the year. And we're also seeing particular strength in self-employed, where people classing themselves as self-employed rose 125,000 through February as well. So real flexibility away from full-time employed in both part-time and self-employed. Bringing this together, it gives continuing strength in pay awards for the UK worker. The annualised growth there is still around 6%. Now, this is going to be much too strong for Bank of England comfort levels. They would much rather see this number down closer towards 4%. But of course, the context has to be that UK inflation is currently around 10%. Now, that's expected to fall materially as we go through the spring, but perhaps this will force the hand of the Bank of England as we approach the next meeting, where markets already expect another increase in interest rates. And we may very well see the Bank of England raise interest rates by around 0.25 percentage points to take levels above 4%. However, that won't be until early May. Elsewhere in markets, it's worth talking about China. What you'll have seen on screen is particular strength in equity markets yesterday. Well, overnight we've had the print for Q1 GDP for China. Of course, this will be the first real data print since the COVID reopening. We saw a huge surprise in GDP, 4.5% for quarter one, and that was led by stronger industrial production and stronger retail sales. So both the household and the private sector really driving the strong growth in China as it comes out of COVID into the spring. But what's unusual about the Chinese economy is that actually inflation is very low. Inflation is now below 1% and falling. So there's still considerable capacity in China to be eaten up before we see anything like an inflation pressure that would worry officials there. In fact, there's still considerable room for unemployment to fall in China. There's still considerable room for new jobs to be added. So we've got no fears about any tightening of monetary policy in China soon, given the considerable capacity that remains there. So there's still room for Chinese equities to do well as they adjust to the post-COVID reopening. Now, looking ahead, tomorrow we get UK inflation data. So please join us then when Jeff Casson, our CIO, will update you on those numbers. Thank you and take care.